Welcome back to Three Towers Investing Channel, where you can get the latest in finance, investment, and innovation. You may be wondering how you're going to survive the inflation or recession that is happening. If you're not prepared for an economic slump, you could lose everything. If you're asking what you should do, then this video is for you. So stay tuned till the end of this video and we'll make sure that you learn something about how to profit despite a threatening economic recession. For those who have a high level of financial security, an economic crisis fortunately presents a huge opportunity. They may be able to accumulate wealth as a result. A recession is a prolonged, considerable decline in economic activity that can be caused by a number of factors, including inflation. During this time, prices rise and the value of the dollar drops. These worries typically result in higher unemployment, a decline in consumer confidence, house foreclosures, and business failures. Due to these factors, the stock market frequently declines as a result of investors' anxiety, lack of confidence, and withdrawal of capital. You must get into the habit of living within your means and spending less than you earn if you want to improve your financial situation at any stage of the economic cycle. Unfortunately, the money left over after expenses and income is used to reduce debt and save for the future. People are caught in the trap of raising their expenses proportionately to their income, which leads to an endless cycle of barely making ends meet. When they get a rise, they buy a new car or a bigger house right away. Living within your means and spending less than you earn may sound boring, but if you start doing it, you'll see how it could change your life and your financial status. Millionaires do not rely on a single paycheck from their job to pay their mortgage or car payments because on average, they have 7 streams of income. If you have many sources of income, you won't be as concerned if one of them goes out. When you live within your means and diversify your sources of income, you can still cover your costs in the event of an unforeseen event. The potential for one of your revenue streams to succeed is perhaps the biggest benefit of having many lines of income. For instance, if you do a 9-to-5 job, you may start a weekend and weeknight side businesses like opening a small coffee shop, a snack bar, or maybe a consulting business. It pays significantly more per hour than a 9-to-5 job. Now that you're making double or triple what you're earning before, you may decide whether to leave your full-time job and concentrate on your businesses or keep them all if you can manage your time. Paying off all your debts at the same time and simultaneously is not right. However, it makes sense to pay off high-interest debt quickly while making the bare minimum payments on low-interest debt. Your extra cash may be invested to earn more interest than you're paying on loans rather than being used to pay off low-interest debt as quickly as feasible. The idea is to maintain investing if your investments outperform the interest on your debt. It makes more sense to invest more funds that may result in a 10% return as opposed to paying off debt with a 3% interest rate. Think about how little you would have to spend each month if you didn't have any credit card bills, car payments, student loan payments, or even a mortgage. This puts you in a far better position to deal with a recession and any potential risk associated with one. If some stuff is important to you and makes you happy, there is nothing wrong with spending money on them. However, the problem arises when you buy goods without even thinking about them. Your budget will be completely depleted if you spend money on items that you might not care about a few days, weeks, or even a month after buying them. And you'll be left wondering where your hard-earned money went when you lose your job or depleted your savings. Before making a large purchase or indulging, you should carefully consider whether or not your future self would value it. By staying away from purchases that will be soon forgotten, you will get more enjoyment out of every dollar spent. It seems as though life as we know it is coming to an end when the stock market declines or there is a recession. Then you ask yourself, will the situation ever be back to normal? It is important to note that the usual recession lasts around a year and a half and occurs every 4 years. A typical bear market occurs every 3.5 years, according to Acorns. It lasts for 9 to 10 months. and on average, the stock market declines by about 35% throughout this time. In conclusion, every 3.5 years, the stock market experiences a 35% decline. But relax, it normally comes back in less than a year. When your assets lose a substantial portion of their value, it is always concerning, especially as you age and it becomes more difficult to replenish that money. Your hard-earned money disappears into thin air, but when you study history and know what to anticipate, these events turn out to be far more predictable. We advise that you set up your portfolio for such situations and steer clear of holding anything you do not want to, keeping in mind that markets are not always in great shape. Always maintain a healthy amount of leverage, which implies that you shouldn't borrow more money than you feel secure having on hand at any given time during the market cycle. The payments are simple for you to make right now, but what if your income drops? The upside of borrowing money is enormous, but you must exercise extreme caution not to over-leverage. You may avoid this by being aware of each market cycle. The poorer the market or economy, the greater the chance for profit, as Warren Buffett has said. When others are fearful or greedy, you should exercise caution. What about your home equity line, which enabled you to take out a loan against a sizable chunk of the value of your home while maintaining little to no equity? When assets reach their previous highs, investors who were in a position to buy them at a bargain are typically richly rewarded. Because purchasing the dip adheres to the fundamental financial tenet of buying low and selling high, it is comparable to timing the market. While it might be difficult to time the market exactly, buying stocks after a major price decline and holding on to them for a long time is a simple strategy. A recession may present a chance for people with excess money to invest, but only if they have a lot of money to risk. Particularly for younger people with little to no prior experience, it's simple to forget how things appeared during previous recessions. When the economy is booming and seems unstoppable, the difficult times seem like distant memories. You'll be far better able to handle a stoppage in income, a big loss in a portfolio, and even the opportunity to capitalize on exceptional market value if you are aware of these moments and are prepared for them. This is in contrast to someone who is unprepared and expects nothing less than a perfect economy in constant growth with their assets, who may lose their home, experience serious issues in their family, and suffer a variety of other detrimental effects. I hope you learned something from our video today. If you do, it would be kind of you if you can share this video with others to inspire them. Thank you for watching. To get more life-changing videos like this, don't forget to subscribe and click the notification bell. We are 3 Towers Investing Channel.